Hey traders from around the world, this is Jerremy Alexander Newsome with Real Life Trading. Hope you're doing absolutely fantastic. Thanks so much for tuning in to the second video. Hopefully you watched the first and you're going to watch the third potentially. So this particular video we're going to be covering risk and we're going to be covering entries. Two pretty important components of the trading system. And then obviously in class 3 we'll be doing a little bit of the same thing, just kind of reiterating that point. And in class 4, the most important, creating the trading plan. Bonito, beautiful. It's going to be great. So let's get started, shall we? Hopping over to WBA. WBA is Walgreen Boots line. So this is the one that we were talking about earlier and mentioned that we had a good gap up today and was a good gap and go. So what we do is I come over to the gap, right? So this has happened after the market opened. So the market at this point has been open for approximately 10 minutes or so. So we have a gap and go, looking at the gap, and I'm saying to myself, okay, great. So it's above all moving averages. All right, the 10, the 20, the 50 exponential, I'll show you guys those now. So those are not really an issue. We're above all of them. We're gapping up. They look great. So we're above the 10, the 20, the 50. We're above the 100, above the 200. Everything's fine. It's a gap and go, and of course, it's clearing pivots. Now, again, the pivots and the gap, those are the most important keys, guys. If you forgot everything you know about moving averages, it really wouldn't be that big of a deal. No worries. So all I'm saying to you is for sure the gap, the candles, the pivots, those are the most important pieces of the puzzle, figuring out who's losing money, who's making money, and why. So we have a good gap, we have this pivot, we have this pivot, we have this pivot, we have these pivots over here. Clearing pivots, great. So the daily chart's a gap and go. So you're saying to yourself, all right, it's a gap and go. What next, Mr. Newsome? Well, from there, then you're going to hop into the hourly chart. And the hourly chart, when you're analyzing it, this is going to help you understand, okay, based on the hourly candles, is it a retest or is it a gap and go? Because at this point, it just simply helps you understand a little bit more about your entry and your timing, what type of gap it should be. So on the daily, it's a gap and go. Strong gap, highly profitable gap, high probability gap. Watch this gap all day. Hop into the hourly chart and you have a white candle. So here's your white candle on the hourly. At this point, you're kind of saying to yourself, well, this is still a good gap for sure. I mean, it's clearing pivots, everything looks nice, but there's a high probability at some point that it will retest. So you're saying to yourself, okay, this is a gap and go gap, but I'm going to wait for a retest. Boom, simple as that. So truthfully, if I had to come up with a percentage, I would say about 90% of the gaps that you end up playing, 90% is approximately how many gaps will be retest gaps. And when I say retest gaps, I mean you're going to be waiting for some kind of retest. It's probably even higher than that, maybe 95, 96. But the majority of gaps, you're going to wait for some kind of retest, some kind of pullback, some type of rest, something. Walgreen Boots Alliance, ticker symbol WBA, is a phenomenal example of this exactly. So what we're going to do in this situation is we're going to break down the entries and all that kind of good stuff and look at everything. So on the hourly chart, you can start with the hourly. Now, if the hourly was black as well, you'd say to yourself, okay, this is a really, really good gap. I'm definitely paying attention to this. Here's the 15-minute candle. 15-minute candle of yesterday is actually black. So you're like, okay, this is definitely a good gap for sure. This thing's going to move a little bit. And then on the 5. So the last 5 minutes. So here's the 5. And again, you had some black candles. So we can say that you have a black candle on the daily, the 15, the 5, and you have a white candle on the hourly. Pretty much all that simply means is you're still waiting for a retest. You're just simply knowing that this is still a really good gap. You should watch it. You should focus your attention on it. You should not deviate very far from this particular gap for today. So the retest. Let's talk about the two most important time frames that we have available to us when we're day trading. The majority of the time, you're going to be focusing your attention on the 5 minute, and the 15. 5 and the 15. Again, folks, there are so much analysts out there and educators and companies who will give you all of their information. I'm not saying I'm the right person. I'm not saying that I know everything. All I'm simply saying is this is what I use. I am a real life trader. Everyone who I interact with is a real life trader, and this is how I make I make money. I make money this way. So if you're looking at this particular trade, I'm just letting you know this is the easiest thing I can give you. And it works. It's easy, it's simple, and it works well. It's not like, well, sometimes it worked that one Sunday. No, well, market's closed on Sunday. You know what I mean. This works, what I'm trying to get at, okay? So the 5 and the 15-minute time frames are the most important, and the same thing with the moving averages. The most important moving average really is the 10 EMA on both of those time frames. The 10 EMA on the 5 minute and the 15. Those are the ones where you're going to get the most bounces from. Those, the 10 EMA on the 5 and the 15. That's where you really, really want to see some nice curvature, some nice bouncing, and some nice moves, and all that kind of good stuff. So Walgreen Boots, W ticker symbol WBA. What to look for? So as soon as this thing opened, it started selling. Boom. So right out the gate, you're like, okay, obviously it's a good thing that I waited for a retest. So you're waiting, and you're watching this more than likely on a 5 minute time frame at this point. And there's a good chance you're going to pull your moving averages up. So again, the moving averages that I use are the 10 to 20 and the 50. The 10 is the most important one, in my personal opinion. Now again, there's a lot of companies out there and analysts who will use the 8 EMA, the 14, the 8 simple, the 8 exponential. It doesn't matter. Find one that you like. Pick it. You can use the 32.8 EMA. Go for it. Whatever floats your boat. Whatever makes your Kool-Aid taste better. I use the 10. 10 exponential moving average. I have for a long time. But honestly, I could trade without the moving averages. It's all about the candles. It's all about the gap. About that gap. No candle. In this situation, it is all about the candles. I look at the candles and I analyze the candles. So here's what we got. Stock gaps up. Trades down, and this is today. Okay, pulls into the 10 exponential, and we did have a trader. Her name is Tina. She did take this trade, and here's your bullish candle. So it's a very, very bullish candle at or near the 10 exponential moving average. That's actually what's called a one white soldier candle. It's the strongest candle that you can get. It's a white candle that opens and closes above the prior black candle's close. It's a long candle. It's out of support. It's a good candle. So here's where you would enter. Here's where you would place your stop. And I'll get all this situated for you on WBA. And again, this is where we're going to get into the risk mitigation. The absolute magnificently important part of trading. Doesn't matter if you're day trading or not, but specifically with your day trading. So these move fast. So you've got to know, just out the gate, my friends, it doesn't matter. When we get into class 4, do not worry about being wrong. You're going to be wrong, and you're going to lose money, especially when you're day trading, about 50% of the time. Don't worry about being right. Do not worry about losing or making money on the trade. Worry about protecting your trade, knowing how to mitigate risk, keeping your money as safe as possible, and trading your plan. Trade your plan. Trade your plan. Class 4 will be enlightening, I hope, but that's the most important thing. You will be wrong about 50% of the time. 50%. Coin flip. Okay, don't get stressed out. It's okay. You can be wrong that many times and still make money. That's just trading. It's not a big deal. It's like being in a relationship, right, guys? We're going to be wrong a lot. So, ladies, thank you for liking us. But we're gonna be wrong. We're gonna do stupid things, but it doesn't matter as long as we offset the good with the bad. You know, it works. Okay, that's what trading is. Make less mistakes than you make correct decisions, I think is the term. Win small, lose big. Win small, lose big. No, totally incorrect. Just making sure you're paying attention. Lose small, win big. Dyslexia. It's one of those things. All right. So the trigger. Well, it retested, right? We knew it was going to retest based on the hourly, or we at least knew that we should wait for the retest on the hourly. Stock pulls in, and then we got the 10 EMA on the 5 minute chart shaping up. And so you're like, okay, this is a great move. I'm going to buy because the 10 EMA on the 5 will be acting as a support. The best, absolute best case scenario is you want the actual moving average to touch the candle like that. That's the best case scenario. I mean, that is like, if you can get that, that is A++. Take that trade, close your eyes, LeBron James layup. Don't miss that trade. Okay. If I will go ahead and say this, if you create your trading plan that says the stock must touch the moving average before I can take the trade, I understand. I can appreciate that. No harm, no foul. Okay? I get it. But in the first, really, this is the first 30 minutes or so of the market. Again, that's about how long the retests take. Most retests take about 30 minutes. The larger the gap, the longer the retest will take. So if the gap is anywhere between 1 and 10%, it'll probably take around 30 minutes, okay? Smaller the gap, obviously, the shorter it'll take for the retest. If it's a really, really big gap, like on QLGC, it might take an hour and a half, 2 hours before it actually even hits the 10 EMA on the 5. So it can take some time. So keep that in mind. The bigger the gap, the longer it's going to take. So this gap wasn't very big today. As you can see over here, you can see the stats for it. So Walgreens Boots, ticker symbol WBA, gaps up, trigger right above the high of the one white soldier candle. Stop at the low of the day, or as I abbreviate it, LOD, low of day. Most people abbreviate it that way. So there you go. That's your entry. So what now? What do you do now? Well, now comes the most important part. In class 3, we're going to talk a little bit more about the actual trade setup and how to get into it. This is just a little bit, just kind of a breakdown of everything. 88.64, that's your entry. Okay, that's the price that you actually go long, or you buy the shares. You get into the trade bullish, 88.64. So what you're going to do is, in advance, when you see this trade forming, when you see this candle start to get a nice big white candle on the 5-minute, you're saying to yourself, okay, here's what I need to know. Is the risk to reward good, number one? And number two, is my stop in a good location? And the answer to both those questions is yes, right? I really, really prefer more than a 1-to-1 before you get to the high of the day. If you're taking a bullish retest. So high of the day is abbreviated HOD. So my preference is a 1-to-2, 1-to-3, 1-to-10. The higher the better is great. As long as it's above a 1-to-1, I'm okay with that. I need it to get above a 1-to-1. All right, so 1-to-1 risk-reward ratio and 88.64. That's where you enter the trade, and then you take your stop, 87.93. This is called your stop value. 88.64 minus 87.93. That gives you 71 cents. That is your stop value. That's the difference between your entry and your stop. Now the fun part. Ladies and gentlemen, in trading, I'm not going to go down this road too much because you will understand this very quickly. This concept is quite simple. How many of you out there have won a trade? You're doing really, really well, and then that one trade just wipes out everything. Because you hold and you hold and you hold and you freak out, and you win, but you can never make money. You never make money. You can never be consistently profitable. It's because you're not managing your risk. I've been there. I've done it. I've bought in the shirt. I had the little squeezy bottle that had the fan that blew the water. I got my hand stamped. I was in line. I got the ticket. I rode the ride. I did all of it, okay? I'm there. I'm with you. All I'm saying is risk mitigation is key. If you don't have money, you don't have money to trade. Simple as that. Keep your money protected. Protect this house, okay? This is your stop value. So when we're referring to our trades, I am, from here on out, going to say R. R stands for risk unit. So when we begin to trade profitably, when you start day trading, I no longer want you to think about the fact that you're trading money. Okay? If money has control over you, you're never going to be a profitable trader. If you have a fear of losing money, you're never going to be a profitable trader. If you're worried about how much money you're going to lose, money is just a number on a screen. That's all it is. It's just I'm not doing this for any other. I just had this money on my desk. I don't know why I have $64. I'm not sure. Anyway, money is just paper. It's whatever we attribute its power to. It's not. It's a tool. So whatever we want to do with it, right? We can use that money to do whatever we want. It's just money. It's not important. It doesn't control your life. It should not control your life. Okay? Money is a tool. You're not greedy if you make a lot of money. Take the shackles off. Make as much money as you possibly want. I'm okay with you making money. Make millions. It doesn't bother me at all. Please go for it. Right? Because usually the people who have the most money, they donate the most, they give the most to charity, they help out the most with their money. I do not know too many fabulously wealthy and greedy people. There obviously are some, but I do not believe fear and greed control the stock market. I think fear and optimism control the stock market, or optimism and pessimism. All I'm trying to say is when you're trading your risk units, it breaks the barrier between your emotional connection of, oh my gosh, I'm losing and I'm making this much money, or, oh, I'm just trading this random intangible letter that doesn't really mean anything. That's exactly correct. So from now on, when you're trading, day trading, swing trading, doesn't matter what type of trading, refer to your risk as your R. Now, how much do you calculate your risk to be? Well, your risk is 1 to 2% of your account. Now, that does not mean that's how much money you invest. That literally means that's how much money you are willing to lose. It doesn't bother me which price you choose. 1% is fine, 2% is fine, anywhere in the middle is fine. Just choose that number and stick to it for a while, okay? Personally, 2% is fine for me. If you want to do 1%, if you have a bigger account, you can use 1%. It's totally your call. But use a number, okay? So I'm going to use 2%. Now again, this is the amount that you're willing to lose. This is your risk unit. This is what you're giving out to the market to hope to get something back, right? You risk 1 to get 2, 3, 4, or more. So a risk unit, that's what that is. So when you're triggering intraday, you have a 71-cent risk. And let's say, for example, you have a $39,000 account. Okay, $39,000. Now, if you have less than that, let's say you only have $5,000 and you want to learn how to day trade, stick with me. I'm going to teach you. It's going to be sweet. That's class 3. So $39,000 account. What is, and let's say again, we're using a 2% of 39,000. So it's pretty much 3,900 times 2, I believe. Let's see. So 10%, that's 1%. So 390 times 2, $780. That is 2% of your account. So that does not mean that you are going to only buy $780 worth of this trade. That means that you are going to risk $780. How? Math. Take 780 and you divide it by your stop value. So your stop value will always be changing. Always. And you can see that this would have, you would buy 1,098 shares. It's a lot of shares. 1,098. So if you're saying, Jeremy, I only have a $39,000 account, I can't trade that many shares. Again, I'll help you out in class 3 a little bit more about how you can leverage your money. Okay. But as of right now, got to understand that that's just the way risk units work. So if you want a smaller risk unit, $390 risk unit, let's try 390. 390 divided by 71 cents equals 549 shares. Okay, so you can do it however much risk you want to do, but that's how you calculate. It's very simple. Your entry and your stop gives you a stop value. This is your risk. This is how much money you're going to lose on the trade, and you divide it by your stop value. Now, in hindsight, this trade worked very well. Well, not really hindsight. It's kind of obvious. Trade just traded right up to the high of the day. So once you get into the trade, then what? Well, let me give you a quick rule. This is a rule of thumb, if you will. If the trade goes in your favor, so it goes in the direction that you anticipate it to go, you should never lose your full R. Ever. Ever, 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 ever. So usually once a stock gets triggered in, I wait about 10 minutes. Wait about 10 minutes and then I'll move the stop just a little bit for the first time if the trade's moving in my favor. Okay. I'll move the stop a little bit and then I'll leave it alone for usually about an hour, hour and a half. So I do not move my stop very often. I move my stop again about 2, maybe 3 times a trade max. Because your goal is to be in the trade as long as possible, to make as much money as often as possible. That's your goal. So your goal is to lose if the trade goes in your favor less than R. So you can see the trade went in our favor. But here's the way you calculate your position size to exit. You take your stop value, which is 71 cents, and you go ahead and immediately find where is my target. You multiply by 2. Now, take 2, 71 times 2 is $1.42. Okay, $1.42. And then you would add that to your entry, obviously, $88.64, and you would get $90.06, which this is perfect because that's right at the high of the day. Look at that. Boom. This was a phenomenal trade. Right at the high of the day. Now, this is the situation where I will give you some new statistics and fill you in on some things I've learned over the last few months and years of my trading. Is normally what some and most traders do is they exit half of their position at their target. And this is what's called 2R. Okay? Because, right, you risked 1R, stock traded to your target, hit your target, and you made 2R on the trade. Makes sense, right? So you risk 1 in order to make 2. Now, again, the majority of traders and myself, I've been practicing this for many, many years, is I will take the half of my position at 2R, and then I'll begin to move my stop. Okay, so in this situation, I would take my stop, I would exit the position at 2R, and I'd move my stop up to here. So initially, when the trade began going in my favor, right, the stop was initially at the low of the day. Once I saw this big, giant white candle, I would have taken my stop, I would have moved it below that wick right there, mitigated my loss, and then traded to my target. Some of the statistics that I've done and that another good friend and friends of mine have done is over the last few months, they've gone through the trades that we post, because when you join the trading floor, we do actually keep track of all the trades that we do. We call them out live, just so like today in class, this was a stock trade that we were looking at. We call it out live. We say this is where we're getting in, this is where we're stopped, this is where our target is. Anyway, we did some analysis, and over 100 trades, we actually were about 5R more profitable if we just took our entire position off the table at our 2R target on every single trade we took, over 100 trades. That's pretty good. I mean, depending on your R, if your R is a $1,000 R, that's $5,000 more than you could have made if you just exited your entire position at 2R. I'm not here to say which one's right or which one's wrong. I can truly say you can honestly come up with whatever plan that you want. I'll give you a few, and I'll show you guys my plan in class 4, and you can tweak it as much as you want. I have one trader who either doesn't do anything until he either loses a full R or makes an R. Once he makes an R, he takes the stop up to break even. Okay? So he doesn't do anything. He's at the R. He moves the stop up to break even. When he hits 2R, he then takes his stop and locks in an R profit. Okay, so he doesn't exit anything at 2R. And if the trade hits 3R, he'll exit all of his position, or he will hold his stop for the entire day until he gets stopped out for 1R or exit at the end of the trading day. There's hundreds of different plans out there. You really can do whatever you want, whichever. They all work. That's the crazy thing is, guys, they all almost work. All of them, to some degree, all strategies work. It's not the strategy that's important. It's can you trade the strategy consistently? That is the key. Can you be consistent? Will you let your emotions get the better of you? And hopefully you don't, because this was a great trade. This was an easy winner. So I'm going to give you an example of a loser now, because I do that. Most trading companies don't. They always just show you the winners, but I don't. I'm going to go to EA Games. Now, EA Games, I say loser. It wasn't that much of a loser, but I'll show you the trade regardless. So here's EA Games. Now, EA Games, I didn't get a chance to hop over to this trade until later in the day. So I saw this trade at about 12 noon. Because there's a lot of stocks to go through. And we were watching it, but it just did not set up for me. Anyway, here's the trade I ended up taking. Entry. Again, this is all hindsight, but I'm gonna show you guys the moving averages and everything in just a little bit. All right, there we go. So let's go to the daily chart. Here's the daily chart. Daily chart. We're hopping over here. Black candle, gaps up right above the pivot. Is that a good gap? Yes, this is a good gap. Are good gaps sometimes not going to work? Yes. Okay, 50-50. Flip a coin. You're gonna win one. You're gonna lose one. That's the way it works. So don't worry about that. This is a good gap. I would take this trade every other day. Well, every day it shows up, I would take this trade. So here's the 5-minute time frame. And again, the 5-minute time frame, here's where I entered the trade. Trigger was 70.62. And the stop was 70.42. That was our exact trade. Okay? And the target was the high of the day. Here's the target for right about 2Rs. There we go. So there's the target, the high of the day. And here's how I determined the target. It was just this wick from this candle. That's the high of the day. It was 70.90. It was actually 70.92, which mathematically isn't quite 2R. But remember, as I said earlier, at the high of the day, if you're trading bullish, I would at least want it more than 1-to-1. If it's 1-to-1.5, 1 to 1.75, as long as it's more than 1-to-1, I'm okay with that. 1-to-2, 1-to-3, 1-to-4, the bigger the better. Okay, it's just like a fish. The bigger the better. So on EA Games, or I'm sorry, I keep saying EA Games, Electronic Arts. We got triggered in at 70.62. So here's exactly what I did. Trade goes in our favor. Boom. Stock moves up. What do I do immediately? What do I do? I move up my stop. Okay, so if the trade moves in your favor, don't lose an R. So boop, there was the stop right there, 70.47. That's where I move the stop up to, 70.47. Okay. Then, as I just mentioned, I oftentimes will leave my stop alone for about an hour, right? I went on, did other things, other trades, looked at other setups, Had my stop and target set up at the same time. So this is an OCO order. Order cancels other. So what that means is if the stock went up and hit my target, my stop would get canceled. And if the stock did this and hit my stop, my target would get canceled. It's a great way to trade because OCO orders allow you to place the trade and walk away. So this is important because if you trade full-time and you work full-time, when I say trade full-time, you do not have to be by the computer for hours at a time. You truly don't. I promise. You can work full-time and still day trade. Now, we do have a swing trade class at Real Life Trading. It's in the afternoon. It's for my people who do work and maybe don't want to trade or maybe just simply don't have the ability. All I'm here to say is if you have just a little bit of free time or a little bit of flexibility or a little bit of freedom at work, you can day trade, even if it's just in the afternoon. Just in the afternoon between February and June of 2015, I'm talking about trading the afternoon from 1 to 4 Eastern, 3 hours. Real Life Trading, myself personally, averaged approximately 7R a month. 7R a month. Now, you might not think that's a big number, but that's a huge number. I'm talking just the afternoon, the last 3 hours of the day. That's a big deal, right? It's a big deal. Taking trades like this one on Electronic Arts. So the stock trades up, and you can see, hindsight's 2020, just barely didn't hit my target. Didn't know it until I came back later. It was right around here. So what I do, I was like, man, it didn't hit the target. Okay, no big deal. I took the stop, raised it up a little bit more. Okay, raised the stop, and then it ended up getting stopped out. Simple as that. So this is one that we lost on. Now, here's the key. So on WBA, if you're keeping track, right, let's say we made 2R on Walgreens. And on this trade, how much do we lose? About 0.2R. That's what you lost. So you're a net in 2 trades. You're 50-50 trader. You were up 1.8R for the day. Now, what is a goal? What is a realistic goal? Well, the beautiful part about this, guys, is since I'm not trying to sell you anything at all, I'm just here to educate. I don't have to blow smoke. I don't have to tell you guys about this grand, giant amount of cash that you're just missing out on because you're not day trading. I don't have to sell you into anything. I'm going to be realistic with you. A realistic goal, a very good goal to reach is 10R a month. 10R a month you can live off of at some point. You can live off 10R a month. So the way it works is you always start, and I always suggest my traders to start with a $50 R, $50 risk. When they're first learning how to day trade with my system, $50 R, that means that you just take it small, steady bites, small chunks out the market, okay? $50 R. You practice. Do that for 3 months just to see where you go. If you make 10R every month for 3 months, that's $1,500, $500, $500, $500, $500, $1,500. And then from there, you can increase your R to whatever it is your account size dictates. So if you have $1,000 R, it's the same exact process if you have a $50 R. 10R a month takes a little bit of time to get there, but I have a lot of traders who do that consistently. Now, you might not hit 7. Sometimes you'll hit 7. Well, I'm sorry. You might not hit 10. Sometimes you'll hit 7, 6, 5, 11, 12, 13. So you'll fluctuate in between. But 10R is a very good number. It's a very realistic number, and it can be done. It's not a stretch. It's not a pie in the sky type of number. It's very, very legitimate. So 50R can easily graduate to 100. 100 can become 200. 200 become 4. 4 become 8. 8 becomes 1,000 or 1,600. We're talking money at that point, guys. I mean, even a $400 R, which I think if you really are consistent, you could get up to a $400 R in about a year, year and a half. And so you're talking about $4,000 a month, which is most people's living. And you're doing that trading. And we're not talking about being from the computer all day. You could trade for 3 or 4 hours, set your stops, set your entries, walk away, and go on to the next thing. So that's EA Games. That is Electronic Arts, ticker symbol EA. And that is a losing trade where I did lose on that. That was today. I'm trying to think of a good bearish retest that we placed recently. Bearish. You know what? Let me actually pull up. I hope I can pull this up. I'm sure I can. I'm going to pull up our trading journal. This is where we track our trades. This is why I do this, because I usually can remember every single trade that I place, but it's been a long day. Day trades current month. So if you guys ever need this document, let me know. I'll be happy to share it with you on our website. All right, so yesterday Yesterday was a good day. It was about a 3R day yesterday. About a 3R day. So right now, I'm going to go look at, let's go look at AT&T. AT&T. We'll go look at that from yesterday. So AT&T is the one that we played bearish yesterday, and you can see that it worked very well today. Here's the 5-minute retest. Boom. There's your entry. There's your stop. Too simple. Too simple. So let's hop over here. So this one was also a good one. Let's go to the daily chart on AT&T, and let's just go through a few things. So here's your daily chart on AT&T, and this is yesterday. So let me just turn all the moving averages off for a second. Question number 1, did it clear a recent pivot? Yes, it gapped down below that short-term support right there, that little red area. That's good. That's more bearish than bullish. Let's get the long-term moving averages up. Where are they? We are above them. Now remember, I said it's a bonus if we're below them, if it's gapping down. But what I mentioned, if we're far away from them, great. Okay, so we're far away from them. They don't really mean anything. No worries. What about the moving averages, the 10, the 20, and the 50? Well, again, we were below the 20, but we were above the 50. So we were in the middle, so there was some room to move there on AT&T, so that's why we liked it. Okay, so we're looking at the daily. What next? Well, from the daily, we come over here to the hourly. Hourly and the daily are both white candles. I apologize, that's obviously black. Black candles, so what does that mean? If they're a black candle on the hourly and the daily, well, on the daily, you automatically know it's going to be a retest. On the hourly, you're like, okay, definitely wait for the retest for sure. Got to wait for this retest. Here's the 15-minute chart. That's actually the 30-minute chart. Here is the 15-minute chart. 15-minute was a white candle from yesterday. So you're saying, okay, there's going to be some people trapped on the 15. And here's your 5-minute. This is just a very, very easy entry. And again, this is hindsight, guys, but this is what we played verbatim, live, called it out. Boom, money. All right, here we go. Retest. Stock gaps down. Boom, 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 boom. Moves very quickly. And here is the buying to close. Buy, 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 buy. So there's the buying to close. So that's people locking in profit. Well, what now? Well, now you play the retest off of the 10 exponential moving average. So our exact trade, let's just go back to the journal. 35.18 by 35.10. So such a home run. 35.18. Here we go. And why are we choosing 35.18? Well, because again, look at the moving averages. It's above the 10 exponential. The stock comes right into the 10. Remember, I said in class 1, if it hits the 10, well, actually, that's this class earlier. If it hits the 10, it's even better. It's perfect. Mwah! Just a nice little kiss off the glass, like a layup, like a Stephen Curry layup. Boop, just off the glass, lays up, beautiful. So if it hits the moving average, even better. That stop is also above the high of this wick. So it's 1 cent above that high. It's 1 cent above the wick. Everything is good. Everything is awesome. And then the trade begins to reverse. You play it bearish off the bounce. And there's your entry, 35.10. So your risk on this trade is 8 cents. Okay. So let's do this with the $50 R. I'll put this in here. $50 R. So you have an 8 cent risk. 50 divided by 0.08 equals. And you do the math really quick. So you look at the trade, and before the trade even gets set up, now you can obviously build Excel sheets and stuff like this to make it even easier for you, but that's 625 shares. 625 shares. There you go. So that's how many shares you would do what? That's how many shares you would go bearish. You would sell short. And you can see the trade works in your favor. Boom. It immediately started working in your favor. That's fantastic. So you automatically know, man, I better lose less than an R on this trade. Even if it's just 1 penny less, I better lose less than an R on this trade. Right? That's my goal. My goal is to lose less than R because it's moving in my favor. So you don't really want to move the stop too tightly. Even if you did move the stop a little bit, right? Don't be too aggressive with your first stop move. Sometimes it's just a penny or two. Even if you moved it down to here, you would have been okay, but you got to keep it above the 10. You can see the stock did retest it again, and then failed perfectly. And you can see that's like a 2.5, 3R trade. It was a great trade overall on AT&T. Bearish, easy, simple. Okay? So there we go. That's the retest. And all retests are played that way. Bullish retest, bearish retest, doesn't matter. They're all played the same way. Right off the 5, just kiss the glass, phenomenal. Now, back over to EA Games really quick. The other reason I played this is, again, the afternoon. The reason I played it in the afternoon today. Oh boy, where is it? There it goes. What was the other time frame I use a lot? The 15. So here's the 15 moving average. So the 15-minute chart on EA games, notice, was right here when I placed it. So there was there was the 15's the red line, and here's my stop, 70.42. So what would have been even better if the 15 EMA was closer like that, probably would have made this trade run a little bit farther. What's very, very important, my friends, if you're trading any trade at all, later in the afternoon or later in the day, make sure the 15-minute 10 exponential moving average is not super far away from the stock. Make sure it's not very extended, because if it's very, very extended, it probably won't work. I'm trying to think of a good example right now. I can't think of one off the top of my head. But for example, right here in the early morning, the 15 exponential moving average, the 10 EMA on the 15-minute chart was way down here. So you wouldn't have used it. Would have been no help. Right? Way up here, the 10 EMA on the 15-minute chart was way down here. So again, that wouldn't help. So you'd rely on the 5-minute chart. So in the afternoon, you're going to rely a lot on the 10 EMA on the 15-minute chart. Here's an example of Apple. Apple today. Apple kind of started to free fall a little bit today, which was great. You can see here's the 10 EMA on the 15. It started to break a little bit of a support right there, and there's your bearish entry right about there, and it just tanked from there. Just really, really moved nicely. So the 15 EMA, I keep saying the 15 EMA, the 15-minute time frame, the 10 EMA, very, very strong pattern. Make sure it's not too far extended from the trade if you're trading later in the afternoon. So this is a good example. Let me just hide all my drawings on Apple for a moment and show you this. Here's another kind of an unwritten rule. If you want to write it down, you definitely can, but it's something to always, always keep in mind. Buy low, sell high. Obviously, it's one of my most favorite. But always look at the candles previous to you and ask yourself, are people being trapped? Look at this. 1, 2, 3, 4, 5, 6, 7. See how far the 10 EMA is on the 15-minute chart? Do not short right here. Right? If you can see the 10 EMA is very, very far away, I'm talking on both the 5-minute and the 15-minute, that 10 EMA needs to be close to the price action before you take a trade. If it's really, really far away, just let it run, let it move, let it do its thing. So let me go back to WBA today, and I'll give you an example. Here is WBA on the 15-minute chart. Some people might have tried to take the breakout of the high of the day. Okay, there's the breakout of the high of the day. Look how many white candles are in a row. 1, 2, 3, 4, 5, 6, 7. Okay, when you start getting 7 candles in the exact same color, you gotta wait. You gotta be patient. I'm sorry. Just miss the move if it keeps going and get the pullback, because there's gonna be a pullback coming. Okay, 7 candles, 6 candles, 8 candles, 9 candles. You start getting all of them in a row, you're like, whoa, 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 whoa. I'm gonna wait a little bit because that's just too extended. Too extended. So always look at the prior price action. Here's the 5-minute. So the 5-minute, notice how, again, we've never touched the 10 at all in the 5-minute once you got up into here. So 1, white candle, white candle, white candle. So you have a string of 4 white candles in a row right there, and you've never, ever touched the moving average. It's healthy to touch the moving average. It is. It's healthy to touch them. So down here, it was close. It was very close to moving averages. Up here, not close. Buy low, sell high. Always a good rule of thumb. Okay, so that's the retest gap. And again, if you guys ever have any questions, you're welcome to email me. You can always send me specific charts. I love looking at charts. We don't have a free room we don't have free weeks or free days into our room very often. But if you want to ever come over there and check it out, you're more than welcome to. Let me find out the other trade, SLW. Okay, so let's look at SLW. This is a trade that I'm in personally bearish. And I want to look at the daily chart, and let's talk about SLW for just a moment and talk about what I like about this gap. So I'm going to zoom out here for a moment, and let's look at this gap that happened the other day. So first and foremost, what type of gap is that? If you're saying gap and go, that is the correct answer. It is a gap and go. So automatically you're saying to yourself, okay, this is a good gap. I should watch this gap. That's what you're saying to yourself. The answer is yes, all right? You should watch that gap. What else is important about that gap? If you're thinking, wow, it did just perfectly clear a very recent pivot, yes, that is the key. Look at this. Boop, boop. So support over here and support over here. It's gapping below support. People are trapped. People are losing money. You can guarantee that someone bought yesterday because it's a nice size white candle. You're at a support, strong support, gap down, trapping people. It's a gap and go, great gap. Watch this gap. So what's the time frame that you go to from here? Well, from here, we're going to go to the hourly chart. And the hourly chart does have a white candle or black candle. The last candle, the most recent candle of the day, was white. That is bullish. Okay, so here is the 15-minute chart. 15-minute chart, you have white candles. Okay, bullish. And on the 5-minute chart, you also have white candle. Look at that. So you have a bunch of white candles. You have the white candle on the daily, white candle on the hourly, white candle on the 15, white candle on the 5, and it's gapping just barely below a pivot. It's trapping people. It's gapping below a support. It's obviously below all the moving averages because it's at the low. It's never been as low as it is right now for the last year or something. So it's obviously below all of those. This is what I refer to as a perfect gap and go. If it's a perfect gap and go, this is a gap. This is a gap trade that you should watch for the swing trade, for the day trade, for long-term trade. These are good gaps. These are awesome. Watch these. Get ready to make some money. Get ready to mitigate your risk. Trade your plan. Okay. Here's how I trade perfect gap and goes. I hop into the 1-minute chart in the morning. If I see a perfect gap and go, no other gaps matter to me. I don't care. I'm watching this one gap all day. Well, at least that morning. I'm watching it vigorously. Okay, I'll put it that way. I'm watching it. So here's the 1 minute. And what I'm looking at on the 1 minute is I'm going to pull my same moving averages up, the 10, the 20, the 50 exponential moving average, and I'm going to wait for some kind of reversal on the 1 minute chart in the first 15 minutes of the day. For 15 minutes of the day, I'm going to wait for some kind of reversal on the 1 minute. So right now on the 1 minute on silver Wheaton, you can see that the stock trades a little bit, and right there is your evening star reversal. You can see that the 10 EMA on the minute chart is starting to catch up. It's getting close to the stock. That's the trade that you're going to play bearish. I don't even have to put the numbers here. I don't even have to do it. You can see what happened. Here's where you'd have taken that trade. That's an evening star reversal. Bearish entry. Stop somewhere up in here above the moving average, just in case the stock did this, right? You would have a better chance of being correct. You can see that this is just an absolute home run. I wrecked this trade. It was amazing. But it is all based on the gap. All based on the gap, the understanding of the gap. So let's say you didn't trade that. And again, the first 15 minutes ends right about here. So let's say you see this hammer candle and you go, all right, I'll take it below the low and I'll place my stop over the pivot. That also would have worked. Well, what if you didn't do that? What if you watched the 5 minute? Okay, so maybe you didn't play the 1 because the 1 minute is very, very aggressive. It does take time and it does take practice. So let's say you only played the 5 minute on silver Wheaton. What would have happened? You guys tell me. What would have happened? Never would have gotten in. Never would have gotten in that whole day. Just kept going down, going down, going down. Is that a bad thing? No, not necessarily. Because then you could say, all right, well, it never retested, but it will. All stocks retest all time frames at some point in their future or in their history, at some level. They have to. It's just human nature. It's the ebb and flow of the market. All trades retest at some time, some point. So here's the 5 minute chart. This is actually the end of that trading day. This is the beginning of the new day. So it never retested. And then here is the retest on the 5 minute on day 2. Evening star reversal, entry, stop. There you go. Another R and a half trade. You also could have played this entry down here, as it started breaking down this support right there, stop above there. You guys can see that, these trades work. They do work. They work well. So from now, what to do? What to do now, Mr. Jeremy, on silver Wheaton? Well, let's go to the 15 minute and ask ourselves, has it retested on the 15 minute yet? Let's zoom in here. And now we're looking at the 15 minute chart. And we can see that, it retested on the 15 right here and it's failed. So now we've retested the 10, the 20, and now we're about to retest the 50 exponential moving average on the 15-minute chart. If you hop into the hourly chart, here's the hourly. You can see that here comes the 10-minute moving average on the hourly to hopefully press it down a little bit farther, and then it'll likely continue lower. So Silver Wheaton, if you're watching Silver Wheaton or you see this video in the past, I'm expecting something like that to happen. I do vastly anticipate lower lows on Silver Wheaton. I could be wrong, but based on this type of gap, I don't think I am. That's why I'm in this trade bearish. I'm in with puts, actually. So let me just open this trade back up. There's my exact entry for the swing trade level, and we'll see what it does. So overall, as far as the gaps are concerned and the time frames, trading is difficult in your mind, but as far as the strategies and the analysis, is not that difficult. The analysis that we did today, that's the analysis I do every single day. It's simple. It's easy. You focus on the gaps. You focus on who's losing money, who's making money, and you mitigate your risk. You trade your plan, and you're consistent. We're going to talk about the trading plan in class 4. Class 3 is next, where I get into a little bit more about leveraging your trades, the actual order entries and things of that nature, and just kind of going from there. So if you have any questions, feel free to let me know. If you want to follow any trades that we post, click that link right there. It'll take you to the video where you can watch how to follow us on TradingView. And of course, feel free to like me on like our page on Facebook, follow me on Twitter, all the social media stuff. And please tell your friends about real life trading, guys. We do our education for free. I believe in education for the world. Let's spread the message, spread the love, and remember, live life, love life, trade it. I'll see you guys later.